Inventory costing. Inventory costing provides you with accurate transaction costs for when products are received, sold, adjusted, or issued to production. It enables you to obtain an accurate evaluation of all inventories held in your company's warehouses for inventory asset valuation purposes in the general ledger. Syspro caters for a multitude of inventory costing solutions, including average, standard, last cost, FIFO or first in, first out, LIFO, last in, first out, and actual costing. Average costing allows you to value inventory at a moving average cost, determine profit margins based on an almost actual cost method, and include all direct costs of manufacturing an item on the item's inventory cost. Average costing is the method that can be used if the warehouse is primarily for distribution, where the product cost fluctuates rapidly, or when dictated by regulation or other industry conventions. These fluctuations include exchange rate variability and even production variability. For example, Daniel runs a department store which stocks a variety of goods, ranging from fresh produce to household furniture. Average costing is ideal for non-perishable inventory items. Dan buys 10 sets of luggage at $200 each, then buys 10 more at $180 each. Average costing will take the sum of these two values and divide it by 2 to get the pricing used on all 20 sets of $190, regardless of the order in which the sets arrived at the store. Standard costing allows you to value inventory at a predetermined cost, determine profit margins based on projected costs, and record variances against those expected costs. For example, one of Dan's salespeople uses a standard selling price for goods when supplying one of their customers with a quote. It is then possible to measure the performance of the salesperson against that standard. His factory manager has applied a cost-saving method during manufacturing. When they perform a job receipt, these variances in prices will be accounted for, and you have a separate measurement for your factory performance. First in, first out costing works on the basis that older stock is sold first, while newer stock is kept for later sales. This is typically used when dealing with perishable goods. For example, Dan's store sells fresh baked goods. Due to the rising cost of ingredients, the first set of 30 baked goods have a cost of 50 cents per item. The next set of 30 costs 80 cents per item, and the final set of 30 has a cost of $1 per item. If they bake 90 goods and sell 70, the cost associated with the inventory is 50 cents for the first 30 sold, 80 cents for the next 30, and $1 for the final 10, and this is what will be reflected on the income statement. The last 20 items will have the most recent cost applied to them at the end of the inventory count. FIFO costing usually results in a predicted higher profit value as the last cost is not taken into account. Last in, first out costing works on the opposite basis from FIFO, as the last item to be receipted into stock will be the first item sold. For example, Dan has a standing order of non-perishable goods like brooms, rags, and other cleaning supplies. One delivery has a cost of $2 per item and $3 for another delivery. If items are sold, LIFO costing will apply a cost of $3 to each item, as it was the last cost recorded for the products, and this is what will be reflected on the income statement. The remaining items will have the oldest cost applied to them at the end of the inventory count. LIFO costing often reflects less profit than FIFO, as the last cost is the value used when evaluating goods sold. To recap, inventory costing provides you with accurate transaction costs for when products are received, sold, adjusted, or issued to production. Syspro has a multitude of costing solutions. Average costing, which averages out the unit cost of an item that is received into stock despite the cost fluctuations. Standard costing, which provides accountability for cost variances and helps monitor individuals' performances. FIFO costing, which ensures that older stock is sold before newer stock, often at a lower cost. LIFO costing, which ensures that newer stock is sold first.